125% tariffs, 84% retaliation. And now, $1 trillion in U.S. bonds is about to explode like a financial time bomb. This is no longer just a trade war, it's a life or death showdown between two superpowers. And your wallet is the very first battlefield. President Trump has raised import tariffs on Chinese goods to a staggering 125%, far beyond any previous level since the trade war began. This isn't just a policy adjustment, it's a clear signal that the U.S. is shifting from a strategy of containment to full-on economic pressure. The impact is no longer limited to industrial materials. Essential consumer products are now in the line of fire. From electronics to home appliances to auto parts, American businesses, especially small and mid-sized ones, importing raw materials from China now face soaring production costs. For everyday Americans, the pain is already creeping onto the shelves, with prices rising on everything from vacuum cleaners to smartphones. At first glance, this policy seems aimed squarely at Beijing. But in reality, the blow may be hitting the U.S. economy just as hard, if not harder. In response to Washington's move, Beijing didn't hesitate to hit back. China quickly announced an increase in tariffs on American imports, from 34% to a staggering 84%, targeting key U.S. exports like soybeans, beef, automobiles, and electronics. The message was clear: hit where it hurts most, American farmers and export-dependent industries. But what really shook global markets wasn't just the tariff hike, it was the threat of an even more devastating move: a potential sell-off of $900 billion to $1.1 trillion in U.S. Treasury bonds, described by experts as a financial nuclear bomb. In this economic war, China is the second largest holder of U.S. debt. And if Beijing decides to dump those bonds on the market, the shockwaves won't stop at the Federal Reserve. They'll reach every American household, every credit card bill, and every mortgage payment. This isn't just a trade dispute anymore. It's a high-stakes game with your financial stability caught in the crossfire. A large-scale bond dump would send prices plunging and push yields through the roof. That means borrowing costs go up, fast. And for everyday Americans, this isn't just a financial theory, it's a reality you'll feel in your wallet. Higher mortgage rates, steeper car loans, credit card interest piling up. Monthly payments get bigger, while your paycheck stays the same. But it's not just borrowers who feel the hit. As the U.S. dollar weakens due to China cutting back on bond purchases, the cost of imports surges. Everyday necessities, fuel, packaged foods, electronics, all risk going up in price. In fact, in less than a week, the 10-year Treasury yield jumped by 0.4%. That's enough to rattle the housing market and send Wall Street into a tailspin. China isn't without risks either. If they dump all their U.S. bonds, the value of what's left will plummet. And since U.S. Treasuries make up a huge portion of Beijing's foreign reserves, that move would be like burning cash to make a point. The economic ties between the U.S. and China run deep. A major shock to U.S. financial markets would ricochet straight back across the Pacific, slamming China's exports, weakening the yuan, and threatening global investments tied to Chinese assets. This is what economists call a lose-lose scenario. Both sides bleed. No one walks away stronger. Instead of dropping a financial bomb all at once, Beijing appears to be switching tactics, opting for soft control with a long-term impact. Gradually reducing USD purchases, quietly trimming U.S. bond holdings, and most importantly, building a parallel financial system powered by the digital yuan, or ECNY. According to unverified reports, as of Q1 2025, ECNY has processed over 1.88 trillion yuan in transactions, spanning more than 200 countries and regions through direct settlement agreements. No SWIFT, no US dollar needed. This is no longer a pilot program. If the data is accurate, then what we're witnessing is a silent financial revolution, a system slowly dismantling the global architecture the US has dominated for nearly a century. It's not just a payment tool. It's China's boldest play to reshape the future of money itself. $5 trillion, an enormous figure, has evaporated quickly. What happened? Trump's tariff policy caused market instability. The US dollar is weakening dramatically. Markets are plunging. And the world is turning its back on these policies. Here are the numbers you can't ignore. Trump initiated the trade war by imposing a 25% tariff on goods from China and other countries. However, the real price to pay has been steep. $5 trillion was wiped out from the stock market just 48 hours after the tariff announcement. These numbers are not just milestones, they are clear evidence of the instability this policy has caused. Over the past period, the S&P 500 has dropped 600 points. The Dow Jones lost nearly 4,000 points. And millions of investors have watched their assets evaporate quickly. Investors are in panic, and this has made global financial markets more unpredictable than ever before. Never has the market fallen into such a state due to a single political decision. The EU and China assert their power. While Trump imposes high tariffs on imported goods, China didn't just retaliate. They raised tariffs to 125% on American products. This means that a range of products like cars, computers, and electronics will become more expensive for American consumers. Not to mention, China has been actively seeking to promote alternative currencies and reduce reliance on the US dollar. The EU didn't stay on the sidelines either. They've taken strong countermeasures and are starting to build new trade alliances, reducing dependence on the US. Countries within the EU are focusing on finding new markets in Asia and South America. Trump's policies have made these countries no longer subjugated. Instead, they are now asserting their own economic power. These alliances are not just long-term strategies but also signals of a shift in the global power balance. While the US continues to isolate itself, other nations are strengthening new strategic partnerships to enhance their influence and foster sustainable development. This is not just a reaction to America's policies, but a strategic move to create a multipolar world. These countries are expanding their influence and preparing for a future that no longer depends on the old powers. America's closest allies are starting to feel a loss of trust in Trump. Canada, Mexico, and EU nations are beginning to seek bilateral trade agreements with other partners such as China and ASEAN. This creates a major concern for Trump's America First policy as key partners are gradually leaving and seeking more independence in trade. For example, Canada has started to renegotiate trade agreements with countries like China as they can no longer endure America's unpredictable trade policies. The EU is also looking to build new relationships, reducing dependence on the conditions set by Washington. This shows that countries are seeking more independence in trade policies and no longer relying on decisions from Washington. America's policies are gradually eroding traditional alliances and driving the formation of new economic blocs. As the US dollar weakens, alternative currencies are quickly rising. The euro has become a safer choice for investors, especially as countries begin to invest more in these currencies. China is also relentlessly pushing to strengthen the yuan, aiming to replace the dollar's role in international trade. The reality is clear. Countries and financial organizations are reducing their reliance on the US dollar and looking for more stable investment channels. This shift is not only changing the flow of currencies but also creating a major transformation in international transactions. Countries are gradually abandoning the US dollar and shifting to the euro, yuan, or even digital currencies. This reflects a shift in global financial strategy as countries seek more stability and independence. In the future, the US dollar may no longer be the preferred choice for international transactions. These alternative currencies are gradually becoming the new power in the global market. So, does Trump realize the situation? $5 trillion have vanished. The US dollar is weakening. And allies are turning away. His tariff policies are causing severe weakness not only to the US economy but also to the global political landscape. The US dollar is no longer the king of currencies. Trump's policies are making other countries seek new deals and create their own paths for independent development. If this continues, the US will face long-lasting economic and political consequences. This change is not only affecting countries, but also shaking confidence in the strength of the US economy on the global stage. The collapse of the US dollar will directly impact global financial stability. Other countries are ready to fill the gap left by America and take control of key markets. In just one night, the stock market soars by thousands of points after Trump announces a tariff delay. But is this a strategy, or just a classic pump and dump? Just yesterday, Trump firmly stated he would never delay tariffs. But in the blink of an eye, he completely changes his mind, announcing a 90-day tariff delay. In the meantime, there will be a 90-day pause on the reciprocal tariffs as negotiations are ongoing. The stock market immediately reacts, soaring thousands of points in one day. Big investors and Trump's close billionaires instantly rake in huge profits. But what's really happening behind this sudden change? Before Trump publicly announced the tariff delay, there were some suspicious trades happening. Big investors were buying stocks and options just before the announcement was made. And when the decision was finally revealed, their profits skyrocketed by 2,100% in just 1 hour. Were these trades the result of insider information being leaked? Or did people with close ties to the Trump administration simply take advantage of the opportunity to profit from the policy change? This is Charles Schwab. It's not just a company, it's actually an individual. And he made $2.5 billion today. He made $900 million, that's not bad. He's in financial. Behind this tariff delay decision, there are unexpected calculations. Who is really benefiting? Big investors. The billionaires in the financial world are the first to benefit from these decisions. Some major players like investment funds and multinational corporations raked in huge profits after Trump announced the tariff delay. It's clear that when Trump makes sudden changes, the big investors are able to profit immediately. Work with us on the negotiations. You know, we have a lot of law firms that have paid me a lot of money in the form of legal fees. We're going to probably use those firms too, if we can. I think we can. I'll make a contribution to the country. But they're great firms, the best firms. The biggest and really the most prestigious. Yet these groups don't face the same risks as the workers, small businesses, and entrepreneurs who are struggling. While Trump's policies might bring short-term benefits to the market and big corporations, the American people are left to face the long-term consequences. Small businesses and everyday workers will bear the brunt of this. As these policies create economic instability, the stock market might go up and down, but workers and low-income American families will face inflation, rising living costs, and job instability. So, does Trump's policy really benefit the American people, or just enrich those who already have power and money? With inconsistent decisions and sudden changes, people are losing faith in Trump's leadership. His policies might cause short-term disruption, but what about the long term? Does the Trump administration truly care about the people, or are they just trying to maintain power for themselves and their business buddies? When the tariff delay was announced, America's allies like Canada and the EU had strong reactions. However, instead of continuing to resist Trump, both quietly accepted the new terms and resumed negotiations with the US on these new conditions. Canada, facing the increase in tariffs from the US, had once vowed to retaliate strongly. But when Trump announced the tariff delay, Canada remained silent and agreed to continue negotiations. Meanwhile, the European Union, which had strongly opposed Trump's tariff policies, had no choice but to accept the new terms. After Trump announced the tariff delay, the EU quickly struck a zero tariff for zero tariff deal. Nonetheless, we stand ready to negotiate with the United States. Indeed, we have offered zero for zero tariffs for industrial goods, as we have successfully done with many other trading partners. Whether this was a strategy or a trick, this decision shifted the market and left significant consequences for the American people. Just a few hours after his strong declaration to not change the tariffs, Trump suddenly panicked, turned around, and postponed the decision. What really happened? Trump's art of the deal painted a picture of bold moves and strategic wins, but the reality that followed has left behind consequences that can't simply vanish with a single policy shift. The instability his decisions caused extended far beyond the stock market. It shook the very foundations of business confidence. Companies need predictable environments to thrive, not one where everything can be undone with a tweet. That unpredictability hasn't gone unnoticed on the global stage either. America's trading partners are beginning to question whether the U.S. can still be relied upon. The trust in America's leadership in trade is eroding. Agreements once considered stable are now viewed with caution, especially after events like the scrapping of the TikTok deal. It's a clear example of policy inconsistency that's making allies nervous. Countries are slowly drifting away from the US, seeking partnerships with nations that can offer consistency and reliability. The price of this erosion could be a steep decline in America's global influence. When allies no longer trust your word, your leadership is weakened. And in today's world, all it takes is a single tweet to shift global markets. On April 8, the Dow Jones spiked over 2,000 points, one of the most dramatic gains in U.S. market history. The catalyst? A brief announcement from the White House suspending tariffs for 90 days. But even more curious was what happened before that. Trump posted, "It's a great time to buy," on social media. That one line spread like wildfire through investment circles. Almost instantly, market sentiment flipped. Indexes turned green, and investors piled back in as if they'd been waiting for the cue. If this was a coincidence, it was far too convenient. The market had been sliding for days, but that one post, paired with the tariff news, sparked a rally. Just days before, U.S. Trade Representative Jamieson Greer was publicly insisting that tariffs would not be paused. He repeated this on national television and in congressional hearings. Markets took him at his word. Then, while he was still testifying, the president announced the tariff pause. The sudden reversal stunned everyone. Was Greer out of the loop, or was this deliberate misdirection? Some started asking whether it was a classic shock and pivot move, create panic, then reverse course so the well-informed can profit from the volatility before the rest of the market catches on. It wasn't long before people started to notice the trading patterns. Data from unusual whales showed a surge in multi-million-dollar options trades just before the tariff announcement. One trade on SPY options reportedly turned $1.3 million into $33 million in under an hour, a 2,100% return. This wasn't normal. It looked too much like someone had insider knowledge. Senator Elizabeth Warren stepped in, demanding an independent investigation. She didn't mince words. If anyone in the administration leaked information for financial gain, it wasn't just unethical. It was market manipulation, plain and simple. Meanwhile, average investors who trusted official statements were left in the dust. They didn't have insider access. They weren't prepared. And in this environment, they never stood a chance. Even the White House press secretary chimed in, saying the media failed to understand the art of the deal. But if this was a strategy, it was a dangerous one, turning financial markets into a stage for political theater, where real people became mere spectators. And that was only the beginning. Days later, the administration escalated its trade war with China, proposing tariffs totaling 104% on Chinese goods. That number, 104%, meant doubling the cost of every imported item. A $400 phone? Now $800. A $25 toy? Now $50. A $30,000 car? Now pushing $60,000. The White House framed it as a punishment for Beijing, but it also triggered a global economic earthquake. China fired back immediately with its own 34% tariffs and restrictions on rare earth exports, materials essential for high-tech manufacturing. These elements, though obscure, power everything from electric cars to military radars. China controls 90% of the global supply, and now U.S. companies must apply for licenses to access them. Experts are calling it a disguised export ban. Within hours, Asian markets plummeted. The Hang Seng Index dropped over 13%, its sharpest fall in 3 decades. Shanghai lost 7%, erasing over $500 billion in value. U.S. markets followed suit, with losses between 10% and 15%. Investors fled to gold and bonds. One analyst called it economic shock therapy, warning it could kill the patient. This isn't just a trade dispute. It's a full-blown confrontation between two superpowers, both refusing to blink. But the real question is, what's the endgame? Is this about revenue, reshoring manufacturing, or simply psychological warfare for leverage in unrelated negotiations? Beijing says it's economic abuse. Washington insists it's tough love. But what's certain is the widening gulf between the two powers, and the rest of the world is caught in the middle. It's the most dangerous game being played on the global economic stage today. Meanwhile, on a lighter yet equally bizarre note, Trump declined to fill out an NCAA March Madness bracket, claiming he should have. A strange omission for someone who thrives on showmanship. But it fits the pattern. If he can't win or control the narrative, he distances himself. And when questioned about not joining the bracket fun, he joked, "I would have participated, but no one recorded it," as if rewriting reality on the fly. It's that same behavior, shifting stories, bold claims, and online tirades, that keeps everyone guessing. Trump's online persona has become a political force of its own. One tweet, and the entire conversation shifts. From social media storms to claims about government money funding gender transitions for mice, yes, really, it's become hard to separate fact from fiction. And while many laugh it off, the deeper concern is real. When the lines blur between truth and spectacle, when markets move on cryptic posts, and when policy shifts happen in the blink of an eye, the foundations of democracy and capitalism begin to crack. It's no longer just about deals or tweets. It's about trust. And once that's gone, it's a long road back.